Welcome back, investors, to Ticker Time News. I'm Adam, and look at the sea of red. Yeah, red. The market today was in retreat, and it was a continuation from yesterday's session. Look at this. I want to show you this. Here's the chart. Actually, first, let me get rid of this. Boom, gone. Look at this chart. This is the 5-minute view of the S&P 500. Ticker symbol SPX. And you can notice here, the past 2 days have been in a very precise channel moving down. Isn't this interesting? But look at this. Let me get my highlighter so I can point these things out. Number one, day 2 yesterday, it began here with a gap down, all right? And then we have this morning. This morning, we opened up pretty much where we closed yesterday, just down a little bit. There was no gap, but as soon as we opened, which was right here, we sold off immediately. And then we sold off all day. But look at this channel. This is a very, very pristine trading channel, right? Up and down and up and down and up. Okay, but look at this. What happened today about 30 to 40 minutes before the close? Look at this. We have that trend line, or the trend line for the top of the channel, for the top of the trading channel. And look what happened. Let me zoom in here a little bit. I'll take that highlighter away, make it a circle instead. We had some pretty big volume come in, all right? More volume than yesterday at the close, just a little bit, but still a little more volume came in today at the close than yesterday. But just look at that. It broke out. It broke out about 30 to 40 minutes before the market closed. But I will put a little caveat on this breakout, okay? We had a breakout, another 5-minute run. Each candle is 5 minutes. But then we got to right around 39.40 and stopped. And if we go back and look nearly perfectly, it lines up with resistance right there, support right there, and support right there, right around that 39.40. I'm going to write that down, and I want you to also, 39.40. Because when we go back to the daily chart, I want to show you where does 39.40 line up. So let's clear off the chart here, okay? We'll get rid of those, the daily marks that we made also. But isn't that interesting? Yesterday and today, a perfect channel, a perfect trading channel. That doesn't happen much between day and day and day. Because if we go back just a little bit further, I mean, look at a little bit further. Do you see very many trading channels in that chaos? No. There's not a lot of trading channels in this chaos that we've been in for the past, I don't know, 2022? Yeah, it's all exciting and fun, right? Well, today's sell-off saw the S&P 500, and I'll go over here to the daily chart to point that out. But it's all the S&P 500, and whether you're looking at the SPX or the SPY, both track the S&P 500, but there's just billions and billions and billions of dollars going through SPX. That's why I like to track it a little bit closer than the SPY. But let me get this chart opened up for you guys so you can see it. And squeezed. Hey, that could be a possibility. Although, what am I doing here? Although, value outperformed growth today. So if there was a squeeze, I would suspect that growth names would be a part of that, not value names. So something to think about. And I think it was close to a % difference between growth and the value stocks today too. So it was a pretty wide margin. Okay, remember I told you to write down 39.40. Let's go find 39.40. And as a matter of fact, I'm going to put a vertical line. Sorry, not vertical, horizontal. You can do Alt H in TradingView. It'll open it up. Double click on the line, and then you can type in 39.40, and you can precisely map out where that is. So the line now is right here. Oh, it lines up. It lines up with something else. It lines up with something else. 39.40. If we go back and look, I'll get the highlighter back out again. There is chop right here at 39.40. Okay. 39.40 also catches some of the chop right here. It also catches that chop. Of course, it gets today's chop, but let me squeeze this a little bit more. What else does it get? It gets this chop. It also catches a lot of that chop. All right. It catches resistance right there. So 39.40 has been a very significant area for chop, right? Where the market is just bouncing around up and down. All right. So that's why that number to me is interesting in that trading channel today. Unfortunately, I have to go back in here real quick. I have to remove those lines, but let me show you one more time what that channel looked like for the past 2 days. I would suggest go into your charts and map out this trading channel here over the past 2 days and watch it tomorrow. Okay. It is very likely that since we have seen Monday and Tuesday down significantly, that we have now witnessed a 2 sigma move. A 2 sigma move that I don't really anticipate us falling much further this week. As a matter of fact, I think we could potentially get a bounce from these levels or a move sideways. But a continued fall like this off of a potential Fed leaker, and not a leaker in a bad way. The Fed wants this information to get out through Nick Timiraos. But yeah, it's interesting. So take a look at that, map it out on your charts. I have it on the 5-minute view. Put your trend lines there. Draw your top trend line first. And then if you right click on that, click clone, all right? And then just take that line and drag it down and line it right up with the low point from yesterday, right around the 10:05 area. There's a low point. Line it up right there, and it'll catch a couple of candle wicks on the way down, and you'll have your trading channel, okay? And that's all in TradingView. So now I'm going to remove it. So that way, when we go to the daily, it's a little bit easier to see, but I'll add them back in when I'm watching the market and potentially trading tomorrow if we get a bounce. Now, these shorts that I started building last Wednesday, I still have open. I have not closed them. They are still open right now. However, if the market can catch a bounce tomorrow, break above that 39.40, then I'll probably end up closing them for now and let the market build up a little bit of steam. Because if we're going to see a Santa rally And just as a quick refresher, as I go into the seasonality chart, December, which is all the way to the right on this chart, we typically rally, right? That's why the name out there of the Santa Claus rally, it is a real phenomenon, right? We typically rally in December, and you can see it there with all the different lines representing different years throughout the midterms, okay? And of course, the top black line, all years together. So we do get a rally. But in order for us to get that December rally, that seasonality, we first need to pull back, okay? From the middle of October, this rising wedge rally, it hit its peak on December the 1st on the down-sloping trend line that has stopped every major rally in 22. Here it stopped the mid-August, and here we go with it stopping the December 1st, the end of our rising wedge rally here. And it's a bearish structure. I called it out. We nailed it. We got this one. Everyone in our private investor community, this information went out about this rising wedge. Hopefully you caught it. It was just due. And we've been talking about for a couple weeks leading up to this that the market is getting ready to hit an inflection point. It's either going to hit that resistance line and fall, or it's going to break through it. And this time it fell. It did not break through it. Now, the fall this week has now erased all of the post-Powell speech gains. Think about that for a moment. Remember the FOMO on Wednesday the 30th? Wednesday, November 30th? Powell's speech, remember? He was in DC. He gave a speech, and the market went from the bottom of that weekly expected move and shot up 3.1%. That was rapid. But all of those gains have now been wiped out. Wiped out. So if you would have bought the morning of Fed Powell's speech, you'd be underwater now. All of those gains have been erased in a few short days. That was one heck of a ride going up. But again, I was loading shorts as we did it because I knew this resistance, it would be tough. So I was placing a high probability on it being rejected. Thank goodness that paid off. Okay, now, where did we hit down here? Okay, we have, and I want to get rid of that 30. Oops, let me go over here. I want to move that 3940 line there for right now. I know there's a lot going on the chart here. Let me open it up a little bit more so we can get a better view of what's happening now. So we all see the blue highlighter there. That is the downsloping trend line that has stopped every major rally in 2022. It held again. It held again. Now, there was a very important place that I think if we could get a rally, a bounce from here, it may become resistance. But I've got a blue line, and it's tough to see because there's also a red line going through it. But it starts here, right? And it catches all of the support and resistance. Quite frankly, a lot of support along that trend line right there. Now we get to here, and today it fell through. Where is this at? This is at 39.55. Okay, 39.55. It's a very choppy area. It is held as support as we went all through this chop box right here. It all held as support, except for one poor little day there. But now that we have gone through it, if we do get some sort of a bounce tomorrow, what's going to happen at 39.55? What's going to happen in that area? Will it turn into resistance? Because remember, old support becomes new resistance. Old resistance becomes new support. It goes back and forth all the time, okay? A support trend line doesn't stay a support trend line forever. They will go back and forth, ebb and flow. Okay, so we got that. Let me clear this off here. So watch 39.55, write it down. It'll be a critical point if we do catch a bid, okay? 39.55. And I want to make sure that I have it written down too, so we can check it tomorrow to see what happened at that area. Okay, why did we sell off? We sold off yesterday off of the Fed's potential thinking that the Fed is going to have to go higher for longer, something we've said for months. But why again today? Well, something significant happened with today's breakdown, okay? First, I'm going to give you the reasons why, and then I'm going to show you why it's significant, okay? So there were concerns about a slowdown in the global economy, along with the market's technical deterioration, where the main driving factors for the continued pullback in equities. Really? That's it. Growth concerns in technical analysis. Really? That was it. I'm not kidding you. Technical analysis is one of the big reasons for why the sell-off continued. Look at this blue trend line, and I've got to adjust this real quick so you guys can see it. I may have to tighten up the candles. Nope, we can get it. But what I'm going to do is I'm going to hide volume for just a moment to make it a little easier to see. So starting back in mid-October, October 13th, okay, we've got this huge green candle, and that sets off, well, that was an intraday low for 2022, the lowest the chart got in all of 22. So that kicked off a rally. And then we get to the beginning of November, and we come back down and we find support here. All right. We even come back down here a little bit later, November the 9th, and we find support, and we get a massive gap up and rally right up to that 39.55 area that I was talking about. And then we chopped around for a while, and we were drawing closer and closer to that downsloping trend line. Well, finally, last Thursday, we got the rally, right? It actually grabbed this support line here and rallied all the way up, nearly touching and breaking through that downsloping trend line. The following day, the wick did break through the trend line, but the candle closed under that trend line. So what's so significant today? Well, look, yesterday, right here on this trend line, we got a bounce. It wasn't much of a bounce. It was a big red day, but it came down and it bounced off of this trend line. So this morning, when the market opened and immediately sold off, it broke this trend line. And you can see we have closed now under that trend line. This is the trend line that supported this current rally from mid-October until the beginning of December. That trend line has now been broken. Is this a false breakdown? Only time will tell, but this breakdown is significant. My concern about this is the weekly expected move is up here at 405. Okay, it's all the way up here. As a matter of fact, let me clean up this chart a little bit before I talk about the. Okay, let me take volume back off here for just a moment. All right, let me bring this down. Why is this so significant? Okay. Well, the weekly expected move is at, I want to take those two marks off. It is right here at, right here, 4,005. Right here is the weekly expected move, 4,005. Now, when we started on Monday, okay, we started right here. That's where we closed on Friday. Now, weekly expected moves are an equation that are calculated using options data, all right? The weekly expected move says that this is where the options market is pricing the next week and where the risk lies. And 68% of the time, let's see how well I can draw a 68. Okay, that's doable. I can live with that. 68% of the time, by the end of Friday, by the end of business on Friday, price should be within the weekly expected move. So for the SPX, that's 4,005 on the lower end. On the top end, that's up here, that is 4138. So the options market said between those two price points, that's where price will end by the close of business on Friday. And it has a 68% win rate. It is basically a 1 sigma move from the Friday closing price up or down, plus or minus, okay? So on Monday, we got that 1 sigma move, and we ended up closing just slightly below the weekly expected move. All right, that's your 1 sigma move. 68% of the time, that's where price will be. Above and below, inside of, so let me put a circle here, inside of this weekly expected move, okay? That's where price will be. But now we've gone and taken it a step forward. Now we've gone to a 2 sigma move from last Friday's close. Do you know how accurate a 2 sigma move is? 95. Oops, that's not a very good 5. 95, and let's see if I can get this circle here. Okay, we got something that looks like a 5. 95% of the time, a 2 sigma move, which would be here, and I'm just imagining right there. 95% of the time, price will close. That's not a good circle there. Let's do better. 95% of the time, price will end by the end of Friday. Price will be within that circle 95% of the time. Okay? A 3 sigma move. So if we dropped another 4.5%, that would put us somewhere like, maybe like down here and, up there. What do you think the percentage is? It's 100% that price will land between those two lines. So the wider those lines are from each other, or the bigger the gap is between the upper end and the lower end, the higher the percentage goes up. That's pretty simple, right? Pretty simple to understand. So now that we are in this 95% of the time area, what do you think price is going to do from here? Do you think price will continue down? I don't think so. This is why I think now may be a good time to watch for a bid. Now that we are a 2 sigma move away from last Friday's close, the options market is right 95% of the time. So that means between where we closed today, 39.41, well, we probably got to go to, I don't know, I'm just taking a random guess here, maybe 4,200 on the top side. That would cover 90% of price action for the remainder of the week. So now is not the time to go short. I'm telling you this because I'm saying now is not the time to go short. Now is the time to look for a bid. The weekly expected move is not a support or resistance line. It is simply marking off an area using options data plugged into an equation that give you these numbers. Now, with that said, when we typically come outside of the weekly expected move, which again is right here, what does price typically do? It goes back to being inside that weekly expected move range. Okay? So that's why I'm looking to see if this market is ready to catch a bid to, at the very least, take us back up to the weekly expected move, which for the SPX is 4,005, and on the SPY, it is 400. Now, it is possible that we just doodle around at this level and close the week down there. That is possible, okay? It is possible that we move sideways along this 39.55 area because it has been a choppy price point, okay? We could just end up chopping along, and that's where we end the week. since we've already dropped so far. I hope that makes sense, everything I've just said. I hope you understand that. And for me, watching the market tomorrow and how it reacts, if we talk about, economic reports tomorrow, there's really only one I'm paying attention to, and that's the consumer credit. So there's really not a lot of action happening tomorrow that could cause the market to continue to sell off like this. Now, I know we could go back in time, okay? We could use a couple of different areas here to really look at this. First off, we've got, let's use most recent. If we look at this big red candle here, that occurred on a Friday. Okay. So where price ended on that Friday, there would have been a weekly expected move that probably looks something, like this. Okay. Maybe a little bit different. So we have Monday, price barely moved. Tuesday, price dropped. We have Wednesday. Thursday, we caught a bid. And Friday, we sold back off again. Okay. So there is that area right here that we could look back to and say, okay, that's one that fell past its weekly expected move, but it bounced on Thursday before selling off again on Friday to end just below that weekly expected move. Another place that we could look at that is real scary looking on the map, but that would be this consolidation right here that led to this huge expansion move down. Okay. But if we look, this candle here was a Friday candle. So week number 1, we do get a big move, probably taking it under its weekly expected move. And then on Friday, getting that 2 sigma move. Okay. So that's a possibility. But since this right here was a Friday candle, all right, so that means this would be the baseline for the next week. We had Monday, Tuesday, Wednesday, we got a bounce, Thursday, and then Friday finished, well, it finished way down here in the weeds. This would be an example of a 2 to possibly 3 sigma move. So they are possible, and they have happened this year. So you do have to keep that in mind, that tomorrow maybe we don't catch a bid, and this is the beginning stages of something that we just looked at. The 2 examples that I just showed you, that we are just sinking from here. However, I will be watching for a potential bounce, because this zone right around the 39.55, it has been such a sticky area in the past. And since we've already gotten a 2 sigma move this week, maybe the rest of the week we come back up to the 39.55 area, float around that particular spot. That's something that could occur tomorrow on the charts, because again, there's not a lot of data that comes out tomorrow that could hurt the market, unless of course there's something that is quote leaked again by the Fed, but I don't think so. I think the Fed is done. They did what they wanted to do. They got this market to slow down. Okay? They got this market to slow down. All right. Let's see here. I want to make sure I got your questions. Thank you. Got it. Good. Awesome. Good job. Let's see here. Bank presidents' negativity on earnings and recession forecast, probably layoffs, may well have caused today's downward move. Yes, I do have a note written here about that. Jamie Dimon, Walmart CEO, they gave separate interviews. It wasn't very good for the markets at all. Let's see here about this one. After 4 down days on SPY, I would expect 400 to act like a magnet, but maybe some chop before upward movement. You've got a great point there. Let me go put the SPY on the map here. The lower end of the weekly expected move for the SPY is exactly 400. So that is important. But 395 is an important area for the SPY because that's where, and if I get my highlighter, the 395 is where all the chop occurred right back here in this time frame. All right, going from November the 10th all the way to the kickoff on November the 30th. We just chopped around. 395 was the main price point, maybe the median price point as we chopped around. So I would think that if we do catch a bounce tomorrow, 395 could be sticky and act as resistance. And then 400, well, it's where the weekly expected move is on the lower end for the SPY. Again, they're not support or resistance areas. So I would think maybe somewhere fluctuating around where we are now, 395, 400 maybe being tops for where the SPY could be going for the rest of this week. Now, we also have to take into account that the Treasury market today, it reflected, got to get my words right, it reflected a belief that inflation is going to come down further. But stocks didn't rally off that price action due to the understanding that the improvement in inflation is apt to be a catalyst or catalyzed, I should say. Gotta get my words right here again. Catalyzed by a significant slowdown in the economy. Look at this real quick. Let's go over here to the 10-year yield and point this out. The load, it's almost there, and we'll get it. Again, we've got this falling wedge pattern again. All right. So yesterday, yeah, the 10-year went up. It rallied. That puts pressures on the Q. But look at today, though. Today, it dropped 1.1%. That should allow the Qs a little bit of help to rise, but it didn't. Its drop today didn't help the Qs at all because everybody had growth concerns on the mind. The 10-year yield, which is what we're looking at right here, it is sensitive to what? Growth and inflation, okay? And it fell 9 basis points to 3.5%. Now, a material slowdown in growth, if not an actual recession, and I'm pretty certain we are going for a deep recession that's triggered by the Fed's ongoing rate hikes. It's piqued concerns that 2023 earnings estimates are what? I've been saying it for months now, are way too high. So Cautious sounding remarks about consumers and or economic outlook. We had them today from CEOs of JP Morgan Chase, Walmart, Union Pacific, all in different CNBC interviews this morning. That definitely, going to your previous point right here, good sir, it contributed to the market's slowdown and its growth concerns. Today's sell-off was orderly in nature too. Let's go look at the Qs here right quick, because they were down substantially, over 2%. It was broad-based. You see the rising wedge here. We've talked about it. The return of the wedges. It broke down through its wedge just as it should have. Just as technical analysis was telling us that we talked about several days last week, Thursday, Friday, and yesterday. But today's sell-off was orderly in nature. And it was fairly broad-based. But a big mega cap, or the big mega cap stocks, they really stole the show. Possibly feeling a bit of pain, perhaps, from tax loss harvesting, which added additional selling pressure. Let's look at the Vanguard Mega Cap Growth ETF, ticker symbol MGK. It was down over 2% today. Look at this, and you're going to think it's like, what? So here we have a rising wedge, and this is for your big mega cap companies, okay? We had price drop, all right? Price dropped, and then it starts to wedge. It did break out of this one time and then came back up. Price continues to bounce around in here, and it did break through today. Is today the big day where it just completely breaks off? I'm not so sure about that, because I'm really thinking we may catch a bid tomorrow. And then this channel within this rising wedge, it may continue. And just as a refresher, okay, chart patterns. When price falls, and I got to clean this up because I got it all messed up yesterday. When price falls, okay, we have that right here. Price fell right here. And then price starts to rise, but consolidate in a rising wedge. What happens? Price typically drops right back down. It's a continuation pattern. Price fell. We are zigzagging back and forth, up and down in this rising wedge pattern. We'll get a breakdown. We had a false breakdown back here at the beginning of November. And this breakdown out of it could be a false breakdown too. So we do have to be a little cautious and be on guard a little bit that what if this is a false breakdown and then we catch a bid right back into the rising wedge and it just continues on for a little bit longer before finally breaking down and continuing the pattern for big mega caps. What if that happens? What if it's just a continuation? We've seen it all year in 2022, right? That's what I'm saying could happen here. Now, again, why I think we may get a bounce tomorrow. We're at these interesting support levels. Plus, the only real economic data that comes out tomorrow is the October consumer credit. And that could show, and just to make sure everyone's aware, that report does not come out until the afternoon hours Eastern time. So it's not something to affect the market in the morning. Again, giving us a potential window to bounce. Okay, I'm just about done with all of my notes here. I just want to wrap up here. I want to move these all these wiggly lines here real quick, okay? And I want to point out something here, especially for the mega caps. Again, ticker symbol for this is MGK. Let's bring this up, open it up a little bit more so you can see where we're at. For the mega caps, for this particular product, the lower end of the weekly expected move is 180. We closed at 181, bottom right hand corner of your screen. You can see the closing price there, 181. Now that 181 price point, if I draw a line through here, that's been support, okay? And then we had a lot of chop around the 180 mark. More support, more chop. And then we take that same 180 back a little further. Support, 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 and chop. So 180 is a very important support level that just so happens lines up with the lower end of the weekly expected move for this product, ticker MGK. So I'm looking for a bounce tomorrow. All right. Let's see here. I want to make sure I get your comments. If I skip it, just yell at me or something. So you think the focus from now on will be growth and not the Fed? I think the focus from twofold. The Fed will still be a focus point, but I think we get clarity from the Fed on December the 14th. Because remember, the Fed is going to go higher for longer than the market expects. Okay. And in that Wall Street Journal report from WikiLeaks, he said that the Fed is thinking about needing to raise rates higher into 2023 for a longer and then hold it there for a longer period of time than the market thinks. That is a key line in his entire article. So, how high is the Fed going? I think the Fed easily gets to 5%. And then where does it go above that? Okay. Does it go significantly above 5%? Maybe to 6, 7? Or is it 5 point something percent? And that's the max. That's the terminal rate for the Fed funds rate. And that's where it'll be. And then December, the Fed raises rates 50 basis points, but gives us a stern talking that says, hey, look, inflation is sticky. It's hanging around. Employment, it's still good. We've got to raise rates higher than we initially thought, even just last FOMC meeting. And we're going to have to hold it there for longer than we expected. Maybe even give us a previous timeline. Maybe they expected to hold it there for 6 months, but now we're going to have to go longer, but we'll let the data ultimately tell us. So there is still a worry from the Fed, but I think we get clarity on the 14th of December about maybe where that terminal rate will be. Is it going to be, again, how far over 5%? And then how long are they going to hold it at that top line? Are they going to hold it there for 3 months? Are they going to hold it up there for 6 months? I think the answer we'll get is the data will determine how long we hold it there. But we do get clarity from the Fed on the 14th. That's what I'm thinking. But the next big deal are earnings. Growth is slowing, okay? When the fourth quarter results are told, which start at the end of January, I'm not really paying too much attention to what their earnings are. What I want to hear is what are their expectations for 2023? What are all of these companies that have said nothing about 2023? What are their thoughts now that they have begun 2023? They saw how the holiday shopping season went, and now they're already going in the first quarter. What are their projections? Because right now, projections for 2023, I believe, are too high. And they need to be brought down. And how tuned in are other market participants about earnings expectations? Do they also believe that earnings are too high? And then the question becomes, just like all of or most of 2022, how high is the Fed going to raise rates? Then the question becomes, well, how low do companies need to revise their earnings estimates lower? Is it $1 per share? Is it $5 per share? Or better yet, what's the percentage, right? Because $1 for one company may be nothing, but it's huge for another company. Do they need to bring their earnings expectations or their earnings projections? Do they need to bring them down 1% or do they need to come down 3%? Because that makes a really big difference. So that will be the fear, I think, in 2023. I think we get clarity from the Fed. The Fed won't matter as much in 2023, except the big question for the Fed will be then, well, how long are you holding? Are you still going to hold rates here? Are you considering lowering rates? That'll be the Fed questions for 2023. But the earnings question will be the one that drives the market crazy in trying to predict. How much lower do equity prices need to go? How much lower do valuations need to go to align with the actual earnings that are being produced? That'll be the market's next big obsession. I think the Fed, it is simply, are you still holding rates? Are you thinking about lowering rates? When are you going to lower rates? And then also, your sales, your revenue, it dropped. You still going to leave your earnings projections as they are, or are you going to lower them? And then how many times are company revising their earnings lower? Because in between quarters, right, companies can revise their earnings up or down. Like, let's say at the end of the quarter when we do our big, quarterly earnings and we did $1 in EPS. Well, I give you my outlook for the next quarter and I say, okay, we're going to do $1 for the next quarter. And we're projecting for the full year, we'll do $4 in EPS. Well, in between quarters, companies can adjust that up and down, right? They get revisions and they can revise it up, they can revise it down. So 2023, I think, is going to be about the revisions and the expectations on earnings. I think that'll be the big kicker for the market then. Okay, so focus from now on will be growth and not the Fed. Yeah, there will be a lot of focus on earnings growth and growth concerns, to be exact, over the obsession with the Fed. Because in the first half of 2023, maybe their very first meeting of 2023, when they come out when Jerome Powell comes out on February the 1st and gives his press conference, maybe they have reached the final rate hike and they are going to hold from there. Then the attention turns to earnings, which are already underway. So the attention has really already turned to earnings. And then the Fed will be the afterthought, where 2022, Fed was front and center, earnings were on the back burner. In 23, that will be reversed, where earnings are on the front burner and the Fed is on the back burner. Because it's raised rates already, it's at its terminal rate, and then at some point, maybe 2024, maybe 2023, I haven't done too much thought or digging about it quite yet, then the Fed starts to cut rates. But that's long off. Maybe second half of 23 or maybe 2024 for that to occur. But earnings growth or lack thereof will be the front burner issue. Okay, so here we go. If 2023 earnings are, on average 20% worse during recession, or if SPY drops 20% more, how does that affect a beta equals to stock like Tesla, 40%? Well, that would be one way to think of it. And let me give this some thought here. So if earnings have dropped 20%, if earnings are on average 20% worse during recession, well, I think if the SPY drops 20% more, that won't necessarily translate to Tesla. Now, Tesla is a big company, and it's got a lot of market cap that it's given up this year. But if the SPY, now let's just go to the SPY while we're here. Oh, that was the SPX. Let's go to the SPY. I'm thinking about your question. I'm giving it some good thought here. I don't just want to shout out an answer, so I am taking a pause to give it some good thought. Because if we look at the SPY right now, It's 17.3% down year to date. So that's where it sits right now. I don't think that just because the SPY dropped, well, what if Tesla earnings hold? What if for some reason Tesla's earnings held? What if Tesla does have growth, but it's smaller? So it's year over year, they are growing. The SPY could still drop even though Tesla doesn't. Let me go look at Tesla's chart here. And let's look at a couple of things here. On the right-hand bottom corner, okay, I'm putting a lot of thought into, glad I just caught that. Putting a lot of thought into Tesla. If we're just being general here and not particularly looking at an individual company, because $105, $107. So, you know, the past 2 quarters for Tesla, its EPS has dropped 2 cents compared to Q1 22 to Q3 22. Not a lot. And we got, that's interesting that, okay, down 53% year to date. Okay, going back to, sorry, I'm just doing some thinking there about Tesla. I'm glad I sold Tesla. I will get back in when this market finds its bottom. Going back to your original question here, then I believe this will be pretty close. So if 2023 earnings are on average 20% worse during a recession, or if SPY drops 20% more, how does that affect a beta equals 2 stock like Tesla, or generally any other stock? I think you're very close to if not pretty darn close. That would be my thinking, at least for right now. That would be my thinking. But it doesn't have to be that bad. It could be 30%, 35%, 35%, maybe up to 40%. If we're just being general about the stocks in the market here, in the SPY. Now, I'm not sure that the SPY is going to drop. I know it's just a kind of hypothetical here. Not so sure that the SPY is going to drop another 20%. It could, but I think maybe when we get to the actual trough of this thing, the actual bottom, I'm thinking like 35% may be it. So the bottom that we hit in the SPY, the SPX, I think the bottom we hit on October 13th, I think that's going to be really, really close to the bottom. Okay. I mean, if you think about, look at the rally that we've been in. I mean, we're just now coming back down to the 50% marker. Another 5 or so points, maybe 8 points. And then we're right back at that 50% marker again for the decline from the middle of August coming down to the middle of September. So then we would have another 50% of retracement to recapture that October 13th low. Okay. No worries at all. I don't mind if they're easy questions, tough questions, or questions that I don't have an answer for. I am happy to if I don't know the answer, I am very happy to say I do not know the answer. Absolutely. But I want to be as helpful as I possibly can. So if I have to think for a moment, it's okay. I don't want to bore you with me sitting here thinking, a really good pondering question like that. Okay, let's see here. If inflation took a lot longer to manifest than the Fed anticipated, shouldn't rate hikes also take longer to show its effects? They are too late. Great point, and you're right. In the FOMC meeting notes from December of 2021, the Fed was discussing inflation's a problem. The Fed was worried in December of 2021 about inflation. And remember, they retired the word transitory. But then they didn't act by raising rates until March. Because the Fed did that, the Fed lost its credibility. It's not an inflation fighter any longer. The Fed became the laughingstock. Everyone knew the Fed should have acted sooner. They should have acted in the fall of 2021. And then maybe inflation didn't get as high. But remember, high inflation is good for governments. They can inflate away some of their debt. But it's not good for the consumer. We don't like paying more for stuff. We want to get a good, fair price. So, shouldn't rate hikes also take longer to show its effects? Yes, you are absolutely correct. However, I just want to put one little caveat here. Look at the Fed funds rate. Just go to on TradingView, Fed funds, and it'll give you the effective Fed funds rate. 3.78%. This is the steepest, and I can actually take these trend lines off. We don't need them. Even the short-term trend line. This is the, as a matter of fact, I can turn every indicator off. This is the fastest rate hike we've been in. This is the fastest rate hikes have increased in modern history, okay? They practically went straight up, 75, 75, 75, 75. We have this one little spot, it's right here on the chart, right here on this blue line going straight up practically. why do we have that little indentation there? Because there was no Fed meeting in August. And since there was no Fed meeting in August, they couldn't raise rates another 75 basis points until their September meeting. And if that little indentation wouldn't be there, this would be straighter than it even is now. But it almost looks like the Fed paused for a month. But that's because there was no Fed meeting in August. So if we just go back in history, we can see the rate has been much higher. As a matter of fact, we have to go back here to 1980. Paul Volcker. 1980, 1981. That's when rates were over 20%. Over 20%. Paul Volcker's mandate was to destroy inflation. And the president of the United States at the time said, go ahead. You have my blessing. You go destroy inflation. And he did. Paul Volcker did. He destroyed inflation by raising rates over 20%. Now, we're not going that high, but we are raising rates. Jerome Powell, who is the Fed president, he is raising rates in a similar fashion to Paul Volcker, except Paul Volcker went from a 10% to a 20%. That's only a 2x move. Now, it's a big number going from 10%, doubling it to 20%, but we started at practically zero. We didn't double, triple, quadruple. I mean, we've like, what, 5x'd or more? I haven't done the math to know for sure, so I'm just kind of throwing that number out there. I just know it's way more than just a 2x move in rate hikes. So they have been fast. The Fed was behind the curve, behind the 8 ball, and it needed to move fast. And it did. But it is going to take some time for inflation to drop. And that's why the Fed, once they reach their final rate hike, they are going to hold it there and leave it high for as long as it takes. Now, I personally believe there's going to be a little problem with inflation when it gets down to the 3 to 4% level. I think that inflation, when it gets to that 3 to 4% level, it might be too sticky to bring it all the way down to that 2% level. Because some of those price increases, consumers would have gotten used to paying this new inflated price, and it becomes sticky and it becomes ingrained into the pricing structure. Now, I really hope that doesn't occur, because I do not want to see any bit of inflation become that sticky that it becomes ingrained in our pricing structure. But there's a little voice telling me that 3 to 4% area, it might be really, really hard to break through, and the Fed just might have to raise rates to crack through it. But we'll see. We'll see. The Fed will definitely slow down their rate hikes. 50 basis point December 14th, maybe a 25 on February the 1st. And then they hold. That's kind of the playbook right now. If Jerome Powell says something different than that effect on December the 14th, we will get some clarity on if that's the actual plan or not. All right. So I hope that answered your question. That's what I was thinking. Okay. I'm totally lost on whether it was about the options question or about inflation, but I'm glad you were thinking that too. Can employers just cut wages too? Oh, that's a good question. Can employers just cut wages too? Yes. Although it's extremely difficult to do so. And it's costly to do so. I've owned businesses in the past. And when you hire an employee, you come to an agreement on what the employer will pay the employee to do a job, a certain set, and it can be different, obviously. If we've got a retail store, maybe they are restocking shelves, maybe they are learning to run the register, maybe they are learning the products that we carry to help customers and customer service. There's a whole multitude of different things that the employee can do for the employer. However, when you agree to come to work, and we're just going to use just made up fake numbers, you agree to come to work for $5 an hour to do X job. Okay. All right. You're doing a great job. Maybe in 6 months, I bump that up and make it $8. You get paid now $8 an hour to do X job. If 3 months go by, or 6 months go by, or a year goes by, and that employee is the best employee you have around, as an employer, you want to do everything that you possibly can to keep that employee happy and there. You don't want them leaving, going to another job. So you may increase their wage that they're getting paid. You may add little extra bonuses here or there. They could be different things. Give out a bonus every once in a while. I mean, there's a multitude of things that you can do as an employer to an employee to make sure they are happy and comfortable and they love coming to do their job. If you as an employer tell somebody that they are going to make X amount of dollars, let's just say $5 an hour, and then 3 months go by and they're not doing so good, and then you cut their wages, to hourly employees, they'll quit. Nope, I'm not doing that. To salaried individuals, to salaried employees, maybe they are more bonus. Let me rephrase that. A salaried individual makes X amount of dollars every year, but the majority of their pay comes from bonuses, right? And bonuses can be for and structured in many, many different ways, okay? You can cut that bonus and that employee isn't, they'll be upset, but they'll understand. Revenues have gone down. Maybe your bonuses are based on revenue. You understand. You're fine. You'll be there. You're okay. But if you go and cut their salary, it's been a rough year. We're gonna have to lower your base salary. Quit. Gone. They're gone. It is emotionally, to an employee, hurtful if their pay gets cut. Maybe their hours get cut, and that's one way to cut their pay, especially for hourly, not for those who are on maybe a commission based or a bonus structure on their base pay. They're just gone. They're not going to stay around for a company that does that. Now, companies will try to, first cut hours if they can, if it's an hourly employee. That's the first thing they'll do. Second thing is they can take a bonus away. But the goal of the employer is not to fire the employee. The goal is to make sure that you are doing everything in your power to keep your best employees. But your worst employees, as a small business owner, you really don't want to fire them, because that can cost you in the long run. You'd rather that they just quit because they don't like it. They're not making enough money, whatever the case may be. So, to your question, there are lots of things employers can do to manipulate what an employee is earning and bringing home. But most employers know, and there are some states that there are some states where I can't think of states off the top of my mind. I've always done my businesses here in the state of Virginia, and it's a right to work. You can let someone go for any reason. But I guess it's possible that there are some states out there. I'm sure big companies would probably stay away from states that might make it illegal to cut somebody's pay, either by just taking a bonus away that maybe the employee thought they would get, or by cutting hours. I mean, again, there's lots of things that can be done, but there may be a state out there that makes it illegal. I'm just not sure of one, but I know here in Virginia, there's lots of things you can do, but you always want to keep your best ones around, because that is the best for the employer and the employee in that situation. Also, goods and services inflation seems engraved now. That's one thing that worries me. I don't want to see inflation become structural within our economy, and the global economy for that matter. Once you start to see signs that inflation is structural, that becomes extremely difficult to lower. it becomes ingrained into this particular product or this particular service. Now, that would just be a no-win. That's a loss for consumers. That can be a loss for businesses. Maybe they just can't keep up paying the higher prices. But the free market, even if inflation becomes structural, a structural part of the economy, the free market will be taking a sledgehammer to said inflation and try to break it apart. The free market will. It'll do its darndest to chip away at that inflation that has become ingrained into products and services. So I do think the Fed, not the Fed, the free market will definitely fight to try to get rid and chip away at that inflation if it becomes structural. And there's a few little signs that maybe some of it is actually becoming structural. And that's why I think that 3 to 5%, I'm sorry, 3 to 4% may be a really hard area to get inflation to come down through. I mean, I don't think Apple and Netflix will lower their subscription prices. That's a great point. However, I would just say that in the streaming world, there will be fluctuations here or there. And there used to be a whole bunch of smaller streamers, and they're being bought up by bigger streaming companies. So it'll be interesting to see how the streaming world will play out. Netflix doing an ad-supported model will definitely be beneficial for Netflix. And that could be a tool that chips away at some of the structural inflation that's out there. Because all it'll take are customers downgrading to a free or a really cheap ad-supported model because times are tough and they got to pinch every penny they can. And just by the way, if you've got some subscriptions out there that you don't use anymore, make sure to cancel them. You want to make sure that your financial house is in order. So, just double check that. Sometimes we sign up for free things, take our trial, and then forget to cancel. I've done that before a time or two, so I got to be careful about those little sneaky little things. Okay. Well, I have finished my notes. If you haven't been aware, I just want to make sure I got through all of your questions. Oh, I'm sorry, I did miss this one. And other CEOs who brag about increasing prices 5 times in 1 year. Oh, man. Yeah, it is something. But the free market will take care of it. If their streaming is just too costly, of course, there's always that core group of customers who get locked in and say, yep, Everything Apple, I buy. Well, a recession, it hurts everyone in a way. And it hurts everybody sometimes in different ways from others. But in the free market, if Apple's price is just too high to pay, if it's a ridiculous amount, and Hulu or Disney or Netflix or somebody takes advantage of that and lowers their price just a little bit, I don't know. I just think the free market will take care of those who abuse a system for too long. I think the free market takes care of it and weeds it out. That's what I think the free market, like in my mind, one of the absolute best time to start a business is in a recession. That may sound a bit counterintuitive, but if you think about it for a moment, during a recession, you've got, maybe, it's a small company in your area, and due to the recession and due to that company not getting their financial house in order during the good times, that they suffer during the bad times and end up going out of business. Maybe a grounds maintenance company, for example. You have a guy come out, he mows your lawn. During a recession, sometimes that's the first thing to go, the guy that comes out and mows the lawn. Or sometimes that's just a job that people don't want to do. So this guy that's been cutting your grass for the past, 5-8 years, the economy's been great, shows up every week or two and is there reliable year after year. And then we hit a recession. In the following year, he doesn't show up. Your grass has now gotten 2 feet tall. Uh-oh. You dig, you look for the number, you look online, and there's nothing, or there's a ghost of a website, sitting there. Well, that's why during a recession is a good time to start a business in some cases. There are some businesses that are capital intrusive at the start to get them up and going, like a restaurant, for example. That's very capital heavy in the onset of getting that off the ground. I mean, you've got to put quite a bit of money into it before your first dollar comes in. But starting it during a recession, you know what hard times feel like. And if you make it through the recession and get past your first 5 years, because that's key, then things turn good. You know that during good times is when you prepare for the bad times. So when that next recession comes, you're not the one going out of business, your competitor is. Because they spent too much during good times. They expanded a little too fast, too far during the good times. And now, because your house was in order during the good times and the bad times, now you can buy your competitor out pennies on the dollar. I absolutely loved owning companies, running them, growing them. Oh, it was awesome. Absolutely awesome. I loved every second of it. All right. Well, are there any other questions? Because I have wrapped up everything that I wanted to talk about. And boy, did I talk today. Let's see here. Well, what do you think of the housing market? They seem to be fighting the Fed pretty well since a lot of prices haven't corrected a whole lot from its parabolic move. You have a good point, good sir. I have seen for months the cracks in the foundation, but the housing market, it really takes that recession to bring those home prices down. And checking the different markets, some markets aren't doing too bad. Other markets have started to fall a little bit more, but we just haven't reached that tipping point yet. And we really have to get into that recession to see that tipping point. I know there's the old adage out there about when interest rates go up 1%, the value of homes drops by 10%. That's an old adage. I don't think that applies in today's world because you've got, number one, B&Bs, which used to be a hot thing. I don't think it's so hot anymore. As a matter of fact, what is it? B&B? What is their ticker? I forget what their ticker is. Oh well. Oh well. I thought anyways, I don't think that's a business that's going to hold up much longer. I think hotels are really making a comeback and are becoming a little more specialized and not so copy and paste. That hotels are going to become, I think they're going to get their second wave, right? And I really think Airbnb, I think it's gonna suffer. I can't believe I forgot their ticker. What in the world? Oh, there it is. Airbnb. Oh, duh. Airbnb. I should have thought of that. Yeah. Look at this thing. Holy moly. This is one that I think could be a short idea. No, you're right. They are. Absolutely. Everyone on CNBC seems hell bent that home prices will not correct significantly. I see it. I see it. You've got some that do, a lot that do, and you got some that say, maybe a little more like me, that we need more homes in America. We've got a housing shortage, not an abundance of homes, and that shortage may help to keep home prices elevated. If these Airbnbs do tank, and I think they're going to, that could soften up. The housing market, because you got these Airbnbers who got their home that they rent out on Airbnb, and I just think that's going to start to dry up quickly. I don't think that's a sustainable business model. Okay. I see hotels coming back more vibrant. They're more specialized. Again, they're not the just typical copy and paste hotels out there. Security is one, I think, that hotels provide that maybe Airbnbs do not. I don't know, But this could be a short idea right here. And if the Airbnbs do collapse, just think those people out there who bought a home specifically for Airbnb, and now they have it and they can't live in it. They already have their own place. They bought this thing, or maybe they bought 5 different homes to Airbnb. Airbnb dries up. What about those homes? They're going to flood the market. That will drive home prices down. See, what we need in order for home prices to go down is we need buyers to step back, and B, we need homes to flood the market. See, we're not getting that. Now, home buying has slowed down. It has slowed down quite a bit, but the economy, we've got to get to that recession, okay? We get to that recession, and that will help to drive home prices down, because people don't like to buy real estate in a recession because maybe their job is a little shaky. Banks become a little more stricter on who and when to lend money. So we need that recession for home prices to really come down. Actually, I should have put this up first. I'm sorry, I missed it. Home prices don't crash without economy to crash. Home prices, did I read that right? Home prices don't crash without economy crash. That's right. We need that recession to help drive down home prices. You guys know, who've been following the channel for a while, back at the beginning of the year, we were in the market to buy a home. We were looking. We were ready to do it. And we got priced out of the market. And then interest rates started going up, and we're like, man, well, we just missed that one. So now we got to wait. We've got to wait for either A, interest rate prices to come down, B, home prices to come down, or C, both occur. Interest rates come down and home values come down before we can do anything. So we're stuck here waiting, which isn't necessarily a bad thing. It's okay. It is what it is. Everything works the way it is right now. But yeah, we definitely need that recession to help bring home prices down. All right, ladies and gentlemen. An hour and 43 minutes. Yeah, I definitely have to wrap this one up. This is a late one. So I'll be back here tomorrow to talk about, after the market is closed, to talk about what happened, why it happened, and what to expect going forward. If you could please click that like button, share this video with a friend. Those 2 things help out drastically. Clicking the like button lets YouTube's algorithm know that we're even here. Sharing it with a friend is a great way to say, hey, check this out. You may find a little value here and there. And of course, if you do like the perspective, please consider clicking the first link in the description. I think you'll find some value there and some actionable information. You are absolutely welcome. This live show is for you. It's why I'm here. It's why I do the live stream every day the market is open, for you to answer your questions. And I hope you guys are finding value out there and enjoy it. So yeah, that's it. I'll wrap it up for tonight. Again, I'll be back tomorrow, and Jerome needs to slam this economy, doesn't he? Doesn't he? Yeah, he does. All right, you are very welcome. Let me just throw that one up there too. Always like to get your questions and comments up on the screen. And that's it. Okay. Thank you, ladies and gentlemen, so very much for watching. I greatly appreciate each and every one of you. Have a good day. Watch for a potential bounce tomorrow in the markets. We could get it. We could get it early. So pay attention. Be ready. And I'll see you back here tomorrow after the market has closed. Have a wonderful evening, and I'll see you in the next video.